Hey everybody, happy Friday. It is Friday, the 20th of February. Thank you for joining me today. I am here as I am every single Friday, giving you an update on the market, what's going on, where I see the markets going, and what moves you should be making. So we are officially in the home buying season, and the season's kind of starting off a little lackluster. I'm not seeing as many buyers actually making offers as what I would normally see going into February. And I think a big part of this is that buyers are kind of watching close. Buyers are, as it says right here, mortgage rates are near 6%, and buyers are watching, but they're not acting. And so that's the key thing that I'm seeing right now. We've got pending home sales have declined. So basically what that means is the number of people who have written an offer on a home, got their offer accepted, and now they're waiting to complete the transaction. And every time that one funds and closes and somebody gets the keys, it's no longer pending, it's closed. But hopefully another one comes in to replace it. So that number should stay pretty steady with some seasonal adjustments. But it dipped year over year. Pending sales went down in January. So that means compared to last year in January, the number of homes that were in contract nationwide has fallen. And so that's a concern as we start out this year. Now, January is historically a slow month. We had a lot of weather-related issues in January as we had the massive snowstorm that hit a big swath of the United States. And so that's maybe part of the story. But as we're looking at it right now, it looks like things are getting off to kind of a slow start. So one of the things that I'll say it this way, which is, buyers aren't rushing. They're not gone, but they're not rushing to jump into the market. And so you've got to figure out, how do I read those tea leaves? If I'm a seller and you want to get sold, you've got to be aggressive about your pricing. If you're a buyer, well, gosh, John, I don't know. I mean, should I strike while nobody else is competing? Or should I wait because maybe they're seeing something I'm not seeing? That's the problem with a market like this. There's a lot of unpredictability. We had another wild card this morning as the Supreme Court ruled that tariffs that were put in place by the presidential administration over the last year have been deemed unconstitutional. So technically, the tariffs are going away. Now, one could argue that that means that inflation is going to come down more because the tariffs were creating inflation. But the tariffs were creating income that funded the federal government, that meant we didn't have to issue as much debt. When the government operates and they need money to operate, they issue debt, and that's in the form of treasury bonds. Well, treasury bonds are a direct competitor to mortgage bonds. And the more treasury bonds they have to sell, the more money the government has to raise in debt, the more they have to pay in interest to attract those investors. And when treasury rates go up, so do mortgage rates. And so there's a big concern that if these tariffs are actually not able to continue, that could cause the debt of the government to go even higher. And that is a big problem for mortgages and mortgage rates, because if rates go up on treasuries, rates typically go up on mortgages. And so we've got a lot of people here who are concerned about timing in the market. And if I'm a buyer, do I wait until prices drop, or are they going to drop? Do I wait until rates drop, or are they going to drop? Well, ideally, you want both if you're a buyer, but you might end up with neither. And that's the hardest thing to decide right now, is timing. And the problem is inventory. So the number of homes that are listed for sale is going up. Now, that's, again, everything can be viewed two ways. So inventory is getting higher. That means there's more homes on the market for you to pick from. It means that there's not as much competition, because if you have 10 buyers in town and only 10 houses for sale versus 10 buyers in town and 20 houses for sale. So the more houses for sale, the more the seller is at a disadvantage. And so buyers can say, well, John, that's a reason why I should wait. But the problem is that first of all, we don't know the quality of that inventory. The good homes sell quickly. So we're seeing more inventory come on, and that could lead to one of two things: more price drops because we have more inventory, or it could lead to more buyers coming back into the market. Buyer rates have been coming down some, and buyers have been patiently waiting. Well, now with rates being close to around the 6% mark on average, and now you have more homes coming on the market, more buyers are going to say, maybe it's time for me to buy again. And now you've lost your competitive advantage. And then here's the other really big wild card. This sounds like a good thing. What do you mean, what if rates drop to 5%? No, but what if rates drop to 5%? How many people are going to be now trying to buy homes? Let me paint a picture for you. Have you ever heard on the news about that one gas station that somehow accidentally or on purpose was selling gas for $1 a gallon? And there was a line around the block and down the street for people trying to get the gas for $1 a gallon. And the funny thing is that the gas station ran out of gas long before anybody in that line got up to the front to get the gas. And the reason why is because the only people that got gas for $1 a gallon were the ones that happened to be lucky enough to be nearby when the prices dropped and plummeted. Okay, so you have to think about that from a home buying perspective. Hey, if rates drop, somebody's going to buy a home, lock in the interest rate the day it drops and get it at 5% and still get a low price. But now everybody else is like, I want to get in on that. And so they're going to start wanting to write offers on homes. And the next house for sale, you have 10 people writing an offer on it, price goes up. And everybody says, well, yeah, but rates are low. So I'm going to come in and now the next house for sale has 15 people writing offers on it and the price goes up. And so you can see how this plays out, that in the dip, when rates drop, there is a perfectly timed situation where home prices were low or lower, were coming down, and you got a really good interest rate, but it bounces every time. As interest rates go down, demand goes up because we have pent up demand. We have a bunch of people who have been sitting on the sidelines waiting to buy a home, and now they're ready to pounce as soon as rates drop. And so lower rates could bring 500,000 more buyers into the market nationwide. Okay, now this isn't my made up numbers. These are statistics that somebody else made up. I'm kind of only partially kidding. So these are numbers that I found from other articles. So I don't know how really true they are, but I do trust the sources that I'm getting it from. And that's why I'm willing to relay that to you. But it could bring up to 500,000 additional buyers if rates drop to 5%. Okay, when rates drop, competition spikes. And that can happen in an instant. And so you have to kind of be careful as you're looking at what's the right move for me, because lower prices don't always mean lower rates don't always mean lower home prices. And that means your payment's going to jump. Okay. So that's the piece. But here's the other piece I want to talk about. I want to talk about property taxes and I want to talk about insurance for a second, because there is a big misunderstanding from a lot of home buyers. And I want to dispel a notion. When you get a 30-year fixed rate loan, your principal and interest payment will never, ever change for the entire 30 years. But your total payment is not just principal and interest. Your total payment includes property taxes and homeowners insurance. It might include mortgage insurance as well. But I'm focusing on the property taxes and the homeowners insurance. That number is simply what that bill is in the most recent year. We take that divided by 12, and that's what we charge you in the upcoming year. Excuse me. So when you become a homeowner, excuse me, your mortgage payment will adjust, not because you don't have a fixed rate, but because just like your car insurance, just like your renter's insurance, every year you renew your insurance policy and that payment changes and it never goes down. Lately has been going up a lot. Now, hopefully that significant increase is now plateaued. I'm not seeing big shocks of higher homeowners insurance for people, but the same holds true for property taxes. Now, in California, property taxes can only go up by 2% per year. So you are capped on how much they can increase. But there is a really big movement right now from a lot of different levels to debate property tax relief specifically for seniors. Now, there's pros and cons to everything, okay? But what's being floated, first of all, the presidential administration, the White House has said, hey, we want to abolish property taxes for seniors across the country. They don't have that authority, okay? The White House covers federal taxes, and they don't even have the authority to eliminate taxes. Only Congress does, but they don't have any authority over property taxes. That is city, county, and state driven. But there's a lot of cities, counties, and specifically states, I should say, that are trying to make some tweaks to property taxes. The biggest one that's happening, I think it's in like 7 states, California is one of them, that they are pushing to eliminate property taxes or reduce significantly property taxes for seniors. That's good news for seniors. It's got to be paid for somewhere else. And so I'm not saying this is a bad thing. I'm simply saying that it's not a zero-sum situation. It's not a matter of, oh, we get rid of property taxes, no big deal. No, the property taxes that you pay fund schools. They fund fire departments. They fund city services. They fund police departments. And so if you reduce the tax base, those services still need to be fulfilled. And so the taxes likely need to go up somewhere else. And so I'm not saying it's a bad idea. I'm not saying it's a good idea. I'm saying it's not as simple as taxes go down and everything is fine, because from a national perspective, sure, hey, this is a good thing, let's talk about it. From a local perspective, they're going to have to raise taxes somewhere else in order to pay for those services that the city and county are providing, because property taxes are one of the biggest revenue sources for city and county governments. And so I just want to make that really, really clear that there's a misunderstanding about the payment. The taxes and insurance do change, and that means your mortgage payment is going to change. But also just kind of filling in as a side note on this whole thing that's happening with the movement to decrease or eliminate property taxes for seniors. But let's kind of go back to thinking about affordability. This is all about affordability. And it's funny because people shop based on a purchase price. I'm going to tell you, when you call me and get it pre-approved, and if you want to get pre-approved, click on that QR code right there. That's my paid political announcement. Once you get pre-approved, I'm going to give you a purchase price and say you are going to shop for something no more than $600,000. Well, I actually am approving you for a monthly payment, because the purchase price can lead to a different monthly payment on one house versus another. Literally, two houses in the same town at the exact same price can have two different monthly payments. Why? Because property taxes can be different on that house. Because homeowners insurance, maybe one house is in a higher fire risk zone than the other. So homeowners insurance can be different. And maybe one has a homeowners association and the other one doesn't. When you get pre-approved for a mortgage, we are pre-approving you for a payment. And the truth is, when you think about buying a house, you're thinking, hey, I don't want to spend more than this much money per month. And then you count on me to tell you what priced home would get you that monthly payment. It's impossible for me to do that. And I'm the best loan officer out there. Okay. It's impossible for anybody to do that, because the payment isn't just about your purchase price and down payment. All of the other variables that we talked about cause the in-contract surprise. And be very careful when you say, no, John, I ran my numbers on Zillow. It's got a little payment calculator over there. Did you drill in deep to see what the assumptions were? Did you see how much they were projecting that you were putting down for a down payment? Did you see what interest rate they were ballparking? Because sometimes they're like super crazy low in an interest rate. And did they even include taxes and insurance in that monthly payment budget? And so you've got to be really, really careful about when you're shopping for homes, because affordability is really the total compensation, the total conversation that you need to be having. And that's really what people buy. So when should you buy? You should buy when you can afford a home and the home that you love is on the market. That's it. Now, afford doesn't mean you're comfortably affording it, because I have not seen anybody since pre-COVID that was feeling comfortable with their monthly payment when they switched from renting to owning. But the fact is that it's a step up that's worth it as long as you can afford it. Sometimes it means short-term changes. Sometimes it means I've got to tighten the belt somewhere. But don't put yourself in a position where you literally cannot afford it, where you're saying, hey, the only way I'm going to be able to afford this payment is if I stop buying anything and everything, and the only thing I do is eat top ramen. Well, unless you love top ramen, that's probably not a sustainable long-term solution, okay? So what's going to happen this spring? The spring market is really unknown. I was having a conversation with a client earlier today who was talking about refinancing a home. They bought their house a little bit over a year and a half ago. They have a little bit of equity built into the property, but they're not sure what the appraisal is going to bring. And they said, John, what do you think is going to happen with values this year? And I said, I can make an argument that it's going to go both ways. The biggest challenge I have right now is we don't know where interest rates are going to go. But if interest rates drop and nothing else big changes, we're going to see house prices go up, which is good for you as a homeowner. It's bad for you who's looking to buy. But I said the opposite could also very easily come true, because builders in markets that there are a lot of new construction homes, builders are driving the market more now than ever in the wrong direction. I've seen more examples in the last 6 to 9 months of builders slashing prices because they got to sell the home. They broke ground. They bought the land. They did all this stuff months and years ago, and now they have to sell it. They can't hold on to the home. And builders spent the last 3 years using creative options, creative options that allow them to keep prices high by offering temporary buy downs of your interest rate, offering special deals on interest rates, offering a new car in the driveway. Okay, that was back in 2006. But the builders have done all these incentives. And then over the last 6 to 9 months, the buyers have kind of said, I'm not impressed. I'm not impressed by your buying down my interest rate. I'm not impressed because I don't think it's worth it. I don't think it's a good deal for me to pay that for the house. But the builder has to sell the house. And so what I'm worried about this spring, and again, depends on which side of the coin that you're on, is I'm worried that the builders are going to say, hey, we got to sell 1,000 homes in Northern California in March. And they get to March 15th and they've sold 100. They're going to drop prices like that because they have to hit their quota. They have homes that they have to sell. A human owner who's reselling their home, they don't have to sell. They can continue. Either they're living in it or they're renting it. And even if they were living in it, they can start renting it out. Now, they might have a little bit of a hardship doing so, but nobody says you have to sell. But the builder's bank says you have to sell that. And so if the builder has to sell 1,000 homes, the builder's going to find a way to sell 1,000 homes. Okay. Sarah, I see your question. I will happily answer it in just a minute. So that's the problem, is that it could shift. The market could shift significantly depending upon demand both ways. If demand is down, prices could drop like that, especially in high new construction markets. And if interest rates drop and buyer demand comes up, then prices can skyrocket. So we are at the most precarious spring season that I can remember for years. Pre-COVID, every year I'm like, values are going to go up starting in March. They're going to keep going up until around July. And that cycle worked every single year without fail until COVID. Then for 2 years straight, prices went up no matter what. And then inflation hit and COVID went away. Anyway, inflation took off in 2022 and prices really didn't go up at all during the year. And now we're at the point where really the market isn't frozen like it had been. The market is being patient. The buyers are sitting on the sidelines waiting to see what's going to happen. And so this is probably the most fragile moment. I don't know what this spring is going to bring. I think we're going to see a lot more activity. The question is, what does that activity look like? And is it going to be driven by buyers in high demand or low demand? Is it going to be driven by interest rates going down or going up? Too many wild cards to say, but it is absolutely a wild spring. And you got to be careful, because one way of looking at this is waiting could cost more than acting. And most of the time, the cost of taking action and wishing that things had gotten you'd waited a little bit longer isn't as bad as waiting and hoping that things are going to get better and then you miss out. Okay. I tell this story a lot, and then I'll get to Sarah's question, which is, if you could go back and buy a home after the market crashed in 2007, 2008, and knowing now that house prices fell every year, 2008, 9, 10, 11. 2011, 2012 is when they hit the bottom of the market. Then it started going up 13, 14, 15, and beyond. And so had you known perfectly when the bottom was going to hit, you were best buying in late 2011, early 2012. But you couldn't have known that. And so the question is, if you could look back and have bought a house in 2009, the prices were lower than they were in 2006, but the truth is they kept going down. If you could go back and do that now, and you had a fixed rate and a fixed payment that you were willing and able to carry as a monthly payment, that it was affordable for you, would you do it? And I propose you would. I would, for sure. Because when you look back over the 10-year period from 2009 to 2019, not including COVID, the price had bounced down 3 years later in 2012, and then skyrocketed higher. Now, it went even higher from COVID. But in the 10-year period from 2009 to 2019, it was still a great time to buy in 2009. And that's what I look at right now, is saying waiting could cost you a lot more than acting, because you don't know where that bottom is. And if you wait and you miss it, maybe today's the bottom. I don't know. And one day, that day is going to be the bottom, and then it's going to take off from there. We're all going to wake up. Hopefully, most of us are going to wake up that day not knowing that it was the bottom of the housing market. but you don't know it until after it's taken off again. And so you have to decide, am I going to wait to look for the bottom because you can't see it until it's gone? And that could cost you a lot. All right, so let's ask questions. So Sarah asked a question about Dream for All. And she said, how much are the origination costs for a Dream for All refinance? They are pretty close to the same as a purchase. When you are refinancing a home, your cost of refinancing is pretty much the same as when you purchase a home. The difference is when you refinance, you don't have to put in the whole year of homeowners insurance. You don't have to deposit as much money for future property taxes because you already have that money sitting there. But the problem is we have to make up for it because the money is sitting in the current account and you need to put it in the new one. And then you get a refund check for this amount about 30 to 45 days after you refinance the loan. So that part you don't have to pay for. Owner's title insurance, you don't have to pay for. Everything else you do. You're looking at the normal loan fees that you're going to pay. A loan is a loan is a loan. You pay the same fees whether the lender is doing a refinance or a purchase. They're doing the work, underwriting, processing, appraisal, credit report fee, flood certification fee. The list goes on. Escrow fees, notary fees, lender's title insurance. They all have to get paid. So when you now, the difference is most refinances, you have equity in the home and you just refinance and you make the loan balance a little bit bigger to cover all those fees. So typically on a refinance, the only fees you're paying out of pocket are credit report and appraisal. Everything else, as long as there's enough equity in the property, is included in the new loan amount. Dream for All changes that math sometimes because you didn't have a lot of equity when you bought. And so unless prices have gone up, you likely don't have room to refinance because you borrowed all the money of what the house was worth when you bought it, which means you're likely going to have to come out of pocket with the fees unless the value of your home has gone up. And again, we've been in kind of a wonky market, and I just spent the last 20 minutes explaining to you why I think there's a lot of arguments that say prices could go way up or way down. I have a client that I talked to today as well, and they weren't sure. They wanted to refinance. They're not sure where housing prices are going to be. So we ordered an appraisal now, and we're going to wait and see what happens this spring. Because if values go down, we have 4 months to close on a transaction using the appraisal that we're ordering right now. If values go up, we just wait 4 months until the current appraisal expires and we order a new one because we can use the new one based on the values that have gone up. So it's costing them an extra $700 or so approximately for the appraisal fee that they might lose because it might be that values go up and they're going to want to order another one and they have to pay again for an appraisal. But it's about strategy and it's about an insurance policy for them that's worth the money. And so they're locking in one value right now, and then we're waiting and watching the market. And that's where I can be really helpful in helping you strategize. I'm really, really good at strategy, whether you're refinancing or purchasing a home. And I am interviewing for the job of being your lender for either one of those. Sarah says, before committing to a refi, how can we get an appraisal? You just have to pay for the appraisal. So a lender, me or anybody else, me, right? Me? Yes, Sarah? Me? Okay. When you do a refinance, all you have to do is get an application completed with a lender, me, and we have to disclose the loan. Okay. And Sarah says, what happens with an extra 5% equity? I'll explain that in just a second. So and I want to keep this applicable to anybody who's doing any refinance. I know that you're talking Dream for All. This particular live stream is going out to all of my channels. And so I don't want to be only Dream for All, but I'll explain the nuances. So with what you're doing on a refinance is I can't collect the appraisal fee from you until I've issued loan disclosures, but I'm not locking in an interest rate because once you lock an interest rate, that rate's only good for 30 days. And if you miss that 30 days, you pay an extension fee, and that creates a problem we don't want to have come out. So therefore, we issue loan disclosures and everything on there is fake. It's pretend. It's what could be true if we were to lock today, but we're not locking today. And then now that I've legally disclosed to you all of the fees that are associated with doing the loan, now I can charge you for the appraisal fee. We get the appraiser to go out, and the appraiser will tell us exactly what the value is in their opinion. That's the problem with appraisals. It's their opinion. Everybody has one. You get it. You know the story. If you don't, I'm not going to tell you on live TV. Anyway, so hopefully that helps answer your question. And yes, if you put the extra 5% equity down, then you have more room. You have more room to include the fees in there as long as the value didn't drop. But it doesn't matter what you paid for the house. It's about what the house is worth today. So if the value stayed the same or went up, you do have room to include the fees. But if the value went down, it could still squeeze you. So hopefully that makes sense. And that's true for anybody doing any type of refinance, whether it's a Dream for All loan or not. All right, so does not look like I have any other questions. So at this point, gang, I want to say thank you for listening. If you are interested in Dream for All, next week I have 3 webinar live streams that I'm doing. Monday, I'm talking about what properties can you buy with Dream for All. So noon on Monday, what properties are you allowed to use, what types of properties, who gets to pick the property, whole thing about that. We're covering that on Monday at noon. Tuesday at 11 o'clock, the portal is open for registration Tuesday morning at 9 o'clock. At 11 o'clock, I'm doing a live stream walkthrough. I'm going to actually do a registration, a fake one, but I'm going to do a registration right in front of you so that you can see exactly how it goes. And then Wednesday night at 7 o'clock every week until the portal closes on March 16th, I'm going to do an entire walkthrough beginning to end, how Dream for All works, and answer your questions. Guys, I really appreciate you listening. If you have questions and I didn't get to you live, post it in chat, email me, scan the QR code up there, and let's get together. You can click a link on there and we can schedule a time to meet, and you can book a time in my calendar. You can start the application process. Whatever I can do to help you to accomplish your homeownership goals is what I'm here to do, and I really appreciate your trust. Have an absolutely wonderful weekend, and we'll talk to y'all soon. Bye-bye.